Let me tell you something that might surprise you, especially if you have been avoiding technology stocks because you think they are too risky for someone your age. I have been investing for over 7 decades now. I have seen technology companies rise and fall. I watched the dot-com bubble inflate and then explode, destroying trillions of dollars in wealth seemingly overnight. I have seen investors my age lose their entire retirement savings because they chased the wrong technology stocks at the wrong time. And I have learned something that most people over 60 never figure out. Not all technology investments are created equal. Some technology stocks are absolutely perfect for retirees. They offer safety, stability, growing dividends, and protection against inflation. Others are speculative gambles that have no place in a retirement portfolio. The problem is that most people cannot tell the difference. They either avoid technology entirely, which means they miss out on some of the best wealth-building opportunities of our generation, or they buy the wrong technology stocks, the speculative ones, the ones that can drop 50 or 60% in a single year and destroy their retirement plans. Today, I am going to share with you exactly which technology investments are safe for retirees and which ones you should avoid at all costs. I am going to explain why certain technology companies belong in every retirement portfolio and why others are essentially gambling chips that should never come near your nest egg. And I am going to show you how to build a technology allocation that protects your capital while still giving you exposure to the most important economic transformation since the Industrial Revolution. But first, let me take you back to a moment that changed how I think about technology investing forever. It was 1999, right at the peak of the dot-com bubble. I was at a dinner party, and a young man, could not have been more than 30 years old, approached me. He was confident, almost arrogant. He told me that I was missing the boat on technology. He said that my refusal to buy dot-com stocks was proof that I did not understand the new economy. He was making a fortune, he said. His portfolio had tripled in 18 months. He was going to retire at 40, maybe even 35. He looked at me with what I can only describe as pity. Here was this old man who just did not get it. I asked him what companies he owned. He rattled off a list of names that meant nothing to me. Companies with no profits, no sustainable business models, no competitive advantages, just stories about how the internet was going to change everything. I asked him what these companies would look like in 10 years, how they would make money, what their competitive moats were. He laughed. He said that old-fashioned analysis did not apply anymore. Traditional metrics were obsolete. Price-to-earnings ratios were irrelevant in the new economy. I ran into that same young man about 3 years later. His portfolio was down over 90%. Most of the companies he owned had gone bankrupt. His retirement at 40 had turned into starting over at 33 with nothing. He was devastated. And he finally understood something that took him a painful lesson to learn. Technology is not inherently good or bad as an investment. It all depends on which technology companies you buy and at what price. That story has stayed with me for over 2 decades now because it perfectly illustrates the difference between intelligent technology investing and speculative gambling. The technology sector includes some of the best businesses ever created alongside some of the most dangerous speculation traps. The key is knowing how to tell the difference. Now, here is what most people over 60 get wrong about technology investing. They think all technology stocks are speculative. They think all technology stocks are volatile. They think technology is only for young people who can afford to lose money and have decades to recover. And for a lot of technology stocks, they are absolutely right. But there is a category of technology companies that is completely different. These are what I call fortress technology companies. They are businesses that have built such dominant positions, such unassailable competitive moats, such consistent cash flows that they are actually safer than many of the traditional blue chip stocks that retirees typically gravitate toward. Let me explain what I mean by a fortress technology company. A fortress technology company has several characteristics that make it appropriate for a retirement portfolio. First, it generates enormous amounts of free cash flow. This is not a company burning through investor money hoping to eventually turn a profit. This is a company that produces billions of dollars in cash every single year, cash that can be returned to shareholders through dividends and buybacks. Second, it has a genuine competitive moat, something that protects it from competition. This could be network effects, switching costs, economies of scale, or brand loyalty. Whatever it is, it prevents competitors from stealing market share and eroding profits. Third, it operates in an industry with secular tailwinds. The products and services it sells are becoming more important over time, not less. Demand is growing, not shrinking. Fourth, it has a strong balance sheet. It does not carry dangerous levels of debt that could threaten its survival in a recession. And fifth, it has a track record of returning capital to shareholders through dividends and buybacks. It treats its shareholders like partners, not like piggy banks to be raided. I want you to really understand this framework because it is the foundation of everything else I am going to tell you today. When you evaluate any technology company, you should be asking yourself these 5 questions. Does it generate strong free cash flow? Does it have a real competitive moat? Is it an industry with growing demand? Does it have a strong balance sheet? Does it return capital to shareholders? If the answer to all 5 questions is yes, you probably have a fortress technology company that is appropriate for a retirement portfolio. If the answer to any of these questions is no, you should think very carefully before investing. Now, let me tell you about the specific technology investments that meet these criteria. The investments that I believe belong in every retirement portfolio. And I want to be very clear about something. I am not talking about speculative bets on the next big thing. I am not talking about companies that might revolutionize some industry someday. I am talking about established businesses with proven track records that happen to operate in the technology sector. The first safe technology investment for retirees is Apple. Now, I know what some of you might be thinking. Apple is a technology company. It makes gadgets. Is not that risky for someone over 60? And the answer is absolutely not. Let me explain why Apple is one of the safest investments available today, regardless of what sector you think it belongs to. Apple is not really a hardware company anymore. Yes, they sell iPhones and iPads and Macs, but the real value of Apple is the ecosystem they have built. Over 1 billion people carry an iPhone. These customers are fanatically loyal. Once you are in the Apple ecosystem, you do not leave. You buy an iPhone. Then you get AirPods because they work seamlessly with your phone. Then you get an Apple Watch because it integrates perfectly. Then you get a MacBook because everything syncs together. Then you subscribe to iCloud for your photos and files. Then you use Apple Music, then Apple TV Plus, then Apple Pay. Every single product makes every other product more valuable. Every single purchase makes it harder for you to leave. Think about what that means from an investment perspective. Apple does not have to convince customers to buy their products every year. Customers are already locked into the ecosystem. They keep buying Apple products because switching to anything else would be enormously inconvenient. All their photos are in iCloud. All their apps are designed for iOS. All their other devices only work seamlessly with other Apple devices. The switching costs are so high that customers stay with Apple even when competitors offer products that might be cheaper or have better specifications on paper. This is what creates Apple's competitive moat. It is not that they make the best phone or the best computer. It is that they have created an integrated experience that no competitor can match. Samsung makes fine phones. Google makes decent software. But neither of them has anything close to Apple's ecosystem. And this ecosystem generates the most beautiful business model I have ever seen. Recurring revenue every single month. Over 1 billion people pay Apple for services. Not once, every month. That revenue is predictable, high margin, and growing faster than their hardware sales.
10 years ago, Apple services revenue was barely noticeable compared to iPhone sales. Today, services generate over $80 billion per year. That is larger than most Fortune 500 companies.
And services have much higher profit margins than hardware. When you sell a physical device, you have to pay for components, manufacturing, shipping. When you sell a digital service, the costs are minimal. Most of that revenue drops straight to the bottom line. Now, here is what makes Apple perfect for retirees. Apple generates over $100 billion in free cash flow every year. Let me say that again. $100 billion in cash every single year. That is not revenue. That is not operating income. That is free cash flow, the money left over after paying all expenses and making all necessary investments in the business. What does Apple do with all that cash? They return it to shareholders. Apple pays dividends that increase every year. They buy back billions of dollars of their own stock, which increases the value of every remaining share. They have returned over $500 billion to shareholders in the past decade alone. Think about what those buybacks mean for your investment. When Apple buys back stock, there are fewer shares outstanding. That means your shares represent a larger ownership stake in the company. Even if Apple's business stayed exactly the same, your shares would become more valuable over time because they represent a bigger piece of the pie. And Apple's business is not staying the same. It is growing. So you get the benefit of business growth plus the benefit of share buybacks. This is an incredibly powerful combination for building wealth. Apple has virtually no net debt. Their balance sheet is a fortress. They could survive any recession, any crisis, any challenge the economy throws at them. In fact, they tend to emerge from recessions stronger than before because weaker competitors fail while Apple keeps growing. During the 2008 financial crisis, many technology companies struggled or failed. Apple kept right on selling iPhones and iPods and Macs. Their business barely skipped a beat. That is the kind of durability retirees need in their investments. When I look at Apple, I do not see a risky technology stock. I see one of the safest, most shareholder-friendly businesses in the world. I see a company that will almost certainly be more valuable 10 years from now than it is today. I see a company that pays growing dividends while its stock price appreciates over time. That is exactly what retirees need. The second safe technology investment for retirees is Microsoft. If Apple is the king of consumer technology, Microsoft is the king of enterprise technology. And in many ways, Microsoft is even more essential to the modern economy than Apple. Think about it. Almost every large business in the world runs on Microsoft products, Windows operating systems, Microsoft Office for documents and spreadsheets and presentations, Azure Cloud Computing for infrastructure, LinkedIn for professional networking, Teams for communication, Dynamics for business applications. These products are not optional luxuries. They are essential infrastructure that businesses literally cannot operate without. Let me give you an example of how deeply embedded Microsoft is in corporate America. Imagine a large company trying to switch away from Microsoft products. They would have to retrain every single employee on new software. They would have to convert millions of documents from Microsoft formats. They would have to rebuild all of their automated processes and integrations. They would have to migrate years of email and communication history. They would have to find replacements for every Microsoft product they use, and those replacements would have to work seamlessly together. The project would take years. It would cost hundreds of millions of dollars. It would disrupt operations and hurt productivity. And at the end of it, the company might not even be better off. And here is the key insight that makes Microsoft so safe. Microsoft's products have massive switching costs. If a company has been using Microsoft products for years, which most have, all of their documents are in Microsoft formats. All of their employees know how to use Microsoft software. All of their systems are integrated with Microsoft infrastructure. Switching to a competitor would be enormously expensive and disruptive. It would require retraining thousands of employees. It would risk losing important data or breaking critical systems. It would take months or years of productivity loss. So companies just do not switch. They keep paying Microsoft year after year after year. This creates one of the most predictable, most stable revenue streams in the entire business world. Microsoft does not have to worry about customers disappearing overnight. They do not have to constantly convince people to buy new products. Their customers are essentially locked in, and they keep paying month after month for decades. This kind of recurring revenue is incredibly valuable because it is predictable and stable. You can forecast what Microsoft's revenue will be next year with reasonable accuracy because you know their customers are not going anywhere. Microsoft has also transformed itself into a cloud computing giant through Azure. Cloud computing is one of the most important technological shifts of our generation.
Every business, every organization, every government agency is moving their computing infrastructure to the cloud. Instead of maintaining their own servers and data centers, they rent computing power from cloud providers.
This is more efficient, more flexible, and often more secure. And there are only 3 companies that dominate this market: Amazon Web Services, Microsoft Azure, and Google Cloud. Microsoft is the number 2 player, but they are growing faster than Amazon in many categories. And cloud computing has extraordinary profit margins. Once you build the infrastructure, every additional customer is almost pure profit. Let me tell you what Microsoft looks like financially. They generate over $60 billion in free cash flow every year. They pay dividends that increase every year. They buy back their own stock consistently. They have more cash than debt on their balance sheet. They have grown their revenue every single year for decades, through recessions, through crises, through every challenge. This is not a speculative technology stock. This is a financial fortress that happens to operate in the technology sector. Microsoft also has an extraordinary track record of adapting to change. In the 1990s, they dominated personal computing with Windows. In the 2000s, they dominated enterprise software with Office and Windows Server. In the 2010s, they successfully pivoted to cloud computing with Azure. Now they are leading in artificial intelligence through their partnership with OpenAI. Very few technology companies have successfully reinvented themselves multiple times. Microsoft has done it repeatedly. That adaptability is incredibly valuable because it means Microsoft can navigate whatever technological changes come next. The third safe technology investment for retirees is what might seem like an unusual choice, but hear me out. It is Visa. Now, technically, Visa is classified as a financial services company, but I think that misses the point entirely. Visa is really a technology company that happens to process payments. Their business model is one of the most beautiful I have ever seen, and it is perfect for retirees. Here is how Visa works. They do not actually lend money to anyone. They do not take credit risk. They do not have to worry about borrowers defaulting. All they do is operate the technology network that processes payments. When you swipe your Visa card, the transaction flows through Visa's network. Visa charges a tiny fee, usually a fraction of a percent, and they do this billions of times per day. Billions of transactions, each one generating a small fee. Add it all up and you get one of the most profitable businesses in existence. Visa converts about 50 cents of every revenue dollar into pure profit. That is an operating margin that most businesses can only dream about. Most people do not understand how incredible Visa's business model really is. They have no inventory to manage. They have no physical products to manufacture or ship. They do not have to hire armies of salespeople to convince customers to use their network. Once the network is established, it essentially runs itself. Merchants accept Visa because customers have Visa cards. Customers get Visa cards because merchants accept them. This network effect creates a self-reinforcing cycle that makes it almost impossible for competitors to break in. And here is what makes Visa so safe. They benefit from the global shift from cash to digital payments. This shift has been happening for decades and it is accelerating. More and more transactions that used to be cash are now electronic. More and more countries are developing digital payment infrastructure. More and more people are using cards and mobile payments instead of paper currency. Every time this happens, every time someone pays with a card instead of cash, Visa makes money. The total volume of digital payments is growing at 8 to 10% per year globally. That means Visa's revenue grows at 8 to 10% per year just from this secular trend. They do not have to do anything special. They do not have to invent new products or take market share from competitors. They just sit there collecting fees as the world shifts to digital payments. Think about what is still to come. In many developing countries, cash is still the dominant form of payment. As these economies grow and modernize, they will shift to digital payments, just like developed countries have. India is rapidly digitizing payments. Southeast Asia is rapidly digitizing payments. Africa is building digital payment infrastructure. Every one of these transitions creates decades of growth opportunity for Visa. The shift from cash to digital payments is maybe 30 or 40% complete globally. There is still enormous runway for growth. Visa has essentially no competition in their core business. Yes, there is MasterCard, and they are also excellent. But Visa and MasterCard together control over 90% of the payment processing market outside of China. New competitors cannot replicate their networks. They cannot replicate the relationships with banks and merchants that took decades to build. They cannot replicate the trust and reliability that billions of customers depend on. This is a monopoly-level competitive advantage. Visa generates over $15 billion in free cash flow every year. They pay growing dividends. They buy back their own stock. They have minimal debt and enormous cash reserves. They have grown their earnings every single year through recessions and crises. When the 2008 financial crisis hit, when banks were failing and the financial system was collapsing, Visa kept right on processing payments and making money. That is the kind of stability retirees need.
The fourth safe technology investment for retirees is an exchange-traded fund, specifically a technology sector ETF like the Vanguard Information Technology ETF.
Now let me explain why I am including an ETF alongside individual stocks. Individual stocks, even great ones, carry company-specific risk. Something could go wrong at Apple or Microsoft or Visa that has nothing to do with the overall technology sector. A scandal, a regulatory action, a failed product launch, a management mistake. These things happen even to the best companies. By owning a technology ETF, you spread your risk across dozens or hundreds of technology companies. You still get exposure to the sector, but no single company failure can devastate your portfolio. The Vanguard Information Technology ETF holds about 300 technology companies. Apple and Microsoft are the largest positions. So you get concentrated exposure to the best companies, but you also get exposure to other excellent technology businesses. Adobe, which dominates creative software and is essential for designers, photographers, and video editors worldwide. Salesforce, which dominates customer relationship management and is used by sales teams at most large companies. NVIDIA, which dominates artificial intelligence chips and is benefiting enormously from the AI revolution. Oracle, which dominates enterprise databases and has incredibly sticky customer relationships. Intuit, which dominates small business accounting software through QuickBooks and consumer tax software through TurboTax. All of these companies benefit from the same trends that make technology attractive. Digital transformation, cloud computing, artificial intelligence, the shift to software-based services. By owning the ETF, you capture the overall growth of the technology sector without betting everything on any single company. The expense ratio on the Vanguard Information Technology ETF is extremely low. You pay just a tiny fraction of a percent per year. This is important for retirees because high fees compound over time and erode your returns. A 1% annual fee might not sound like much, but over 20 years, it can cost you hundreds of thousands of dollars. Low-cost ETFs let you keep more of your investment returns. Now let me talk about which technology investments retirees should absolutely avoid, because this is just as important as knowing what to buy. The wrong technology investments can destroy a retirement portfolio in months or even weeks. First, avoid any technology company that is not profitable. I do not care how exciting the story is. I do not care how revolutionary the technology seems. I do not care how fast revenue is growing. If a company is not generating profits, it is burning through cash. And companies that burn through cash eventually run out of money. When that happens, they either go bankrupt or they dilute shareholders by issuing more stock. Either way, investors lose. This is what happened to hundreds of companies during the dot-com bust. It is what happened to dozens of companies in the 2021 and 2022 technology crash. These companies had great stories, exciting products, impressive revenue growth, but they were not profitable. And when the market stopped believing in the story, when capital became more expensive, these companies collapsed. I have seen this pattern repeat itself so many times over my investing career. Young investors get excited about some new technology or trend. They buy stocks in companies that are growing rapidly but losing money. They tell themselves that profits will come later, that right now growth is what matters. And sometimes they are right. Some of these companies do eventually become profitable and reward early investors handsomely. But far more often, the profits never materialize. The companies keep burning cash until they run out. And investors lose everything. As a retiree, you cannot afford to own companies that might go bankrupt. You do not have decades to recover from a loss. You need companies that generate cash, not companies that consume cash. Stick with profitable, established technology businesses. Second, avoid any technology company that you do not understand. I have said this many times, and I will say it again. If you cannot explain how a company makes money in a few simple sentences, you should not own it. This is especially true for technology companies, which can be complex and confusing. There are technology companies working on things like quantum computing, blockchain, metaverse platforms, autonomous vehicles, and dozens of other cutting-edge technologies. Some of these technologies might change the world someday, but most retirees, and frankly most professional investors, do not have the expertise to evaluate which companies will succeed and which will fail. When you do not understand a company, you cannot evaluate its risks. You cannot determine whether its stock price is reasonable or wildly overvalued. And most importantly, you cannot have the conviction to hold through volatility. When a stock you do not understand drops 30%, you do not know if it is a buying opportunity or a warning sign. You will likely panic and sell at exactly the wrong time. Stick with technology companies whose businesses you can clearly understand. Apple sells phones and services to loyal customers. Microsoft sells essential software to businesses. Visa processes payment transactions. These are simple businesses that anyone can understand. Third, avoid any technology company with excessive debt. Technology is a fast-moving industry. Companies that dominate today can be disrupted tomorrow. When a technology company is heavily indebted and the industry shifts, they may not have the financial flexibility to adapt. They have to keep making debt payments even as their revenues decline. This is a recipe for bankruptcy. Look at what happened to some of the large technology companies that took on debt to fund acquisitions. When their businesses struggled, the debt became a crushing burden. Some recovered, but many did not. Retirees cannot afford to own companies that might be crushed by their own debt loads. Fourth, avoid any technology company that depends on a single product or customer. Concentration risk is dangerous. If a company derives most of its revenue from a single product and that product falls out of favor, the company could collapse. If a company depends on a single large customer and that customer takes their business elsewhere, the company could collapse. This is why I like technology companies with diversified revenue streams. Apple has the iPhone, but also the Mac, iPad, watch services, and more. Microsoft has Windows, Office, Azure, LinkedIn, and dozens of other products. Visa processes payments across every industry and geography. Diversification provides protection. Fifth, avoid initial public offerings, or IPOs, of technology companies. When a company first goes public, you are usually buying at the worst possible time. The company and its investment bankers have engineered the IPO to maximize the price they receive. They have timed it for when market sentiment is most favorable. They have crafted a compelling story that makes the stock seem irresistible. And they are selling to you at the highest price they can get. This is not a recipe for great investment returns. Studies consistently show that IPOs underperform the broader market over the following years. For retirees, IPOs are speculative bets that have no place in a retirement portfolio. Sixth, avoid cryptocurrency and anything related to it. I know this is controversial. I know there are people who believe Bitcoin is the future of money and will be worth millions of dollars someday. But here is what I know. Bitcoin produces nothing. It generates no cash flow. It pays no dividends. Its value depends entirely on someone else being willing to pay more for it in the future. That is speculation, not investing. And speculation has no place in a retirement portfolio. The volatility of cryptocurrency is extraordinary. Bitcoin has dropped 50% or more on multiple occasions. For someone in retirement, that kind of volatility is simply unacceptable. You cannot afford to have half your portfolio evaporate because of a speculative asset. Stick with businesses that produce real goods and services and generate real cash flows. Now let me explain how to actually build a technology allocation within your retirement portfolio. Because even safe technology investments need to be sized appropriately. You do not want to have so much technology exposure that a sector downturn devastates your retirement. But you also do not want so little that you miss out on the wealth building potential. For most retirees over 60, I would recommend keeping technology exposure to between 15 and 25% of your total portfolio. This gives you meaningful participation in the technology sector's growth while maintaining diversification across other sectors. If technology stocks decline, which they will at some point, your portfolio will be impacted but not destroyed. Within that technology allocation, I would suggest the following approach. Put about 50% into the technology ETF for broad diversification. Put about 20% into Apple, which I consider the highest quality technology company for retirees. Put about 20% into Microsoft, which provides essential enterprise technology exposure. And put about 10% into Visa or a similar payment processing company, which gives you exposure to the shift from cash to digital payments. This portfolio gives you exposure to the best fortress technology companies while maintaining diversification through the ETF. You are not betting everything on any single company. You are not taking excessive risk, but you are positioned to benefit from the ongoing digital transformation of the economy. Now, let me address something that I hear from retirees all the time. They say that they're afraid of technology stocks because of volatility. They have seen the charts. Technology stocks can drop 30, 40, even 50% during market corrections. How can that possibly be appropriate for someone who is retired or approaching retirement? Here is my answer. Volatility is not the same as risk. Volatility is price fluctuation. Risk is the permanent loss of capital. These are completely different things. Let me explain. When Apple stock drops 30% during a market correction, Apple, the business, has not changed. They are still selling phones to loyal customers. They are still generating $100 billion in free cash flow. They are still paying dividends and buying back stock. The stock price has gone down, but the underlying business is exactly the same. If you do not sell during the panic, you do not lose anything. The stock price recovers, usually within a year or two, and you are back where you started or higher. Now compare that to actual risk, the permanent loss of capital. If you buy a speculative technology company that goes bankrupt, your money is gone forever. It does not matter how patient you are. The company does not exist anymore. There is no recovery. That is real risk. That is what retirees need to avoid. The fortress technology companies I have described do not go bankrupt. They have too much cash, too much market dominance, too many loyal customers. When their stock prices drop during market corrections, it is a buying opportunity, not a permanent loss. Yes, the volatility can be uncomfortable. Yes, it can be scary to see your portfolio value decline. But if you own the right companies and you do not panic sell, you will be fine. This is why asset allocation matters. If you have 20% of your portfolio in technology and technology stocks drop 30%, your total portfolio is only down 6%. That is manageable. You can handle a 6% decline without it affecting your retirement lifestyle. But if you have 80% of your portfolio in technology and it drops 30%, you are down 24%. That is painful. That might force you to sell at the wrong time. Proper asset allocation protects you from making emotional decisions during market downturns. Let me also talk about how technology fits into the overall retirement picture. Retirees have specific needs that younger investors do not have. You need income to cover living expenses. You need protection against inflation, which erodes purchasing power over time. You need stability because you do not have decades to recover from losses. And you need some growth because retirements can last 30 years or more, and you need your portfolio to keep pace with rising costs. The fortress technology companies I've described actually address all of these needs. Apple pays growing dividends and is authorized to buy back enormous amounts of stock. Microsoft pays growing dividends and buys back stock. Visa pays growing dividends and buys back stock. These payments provide income that grows over time, helping offset inflation. The stock buybacks increase the value of your shares, providing growth, and the financial strength of these businesses provides stability. Technology companies are also natural inflation hedges. When inflation rises, Technology companies can raise their prices. Apple can charge more for iPhones. Microsoft can charge more for software subscriptions. Visa takes a percentage of transaction values, so when prices rise, their revenue rises automatically. These businesses are not harmed by inflation the way fixed income investments are. They adapt to inflation and pass higher costs through to customers. This is especially important for retirees today. We have been through a period of significant inflation over the past few years. Prices for food, housing, healthcare, and other necessities have all increased substantially. If your portfolio is entirely in fixed income investments like bonds, you are losing purchasing power every year. The interest payments stay the same while everything costs more. But if you own technology companies that can raise prices and grow earnings, you maintain and even increase your purchasing power over time. Now, let me share some wisdom about how to think about your technology investments over time. Because successful investing is not just about buying the right stocks, it is about holding them through volatility and resisting the urge to make emotional decisions. The financial media wants you to trade constantly. They want you watching their channels every day, reacting to every piece of news, buying and selling based on their recommendations. This is how they keep you engaged and watching their advertisements. But it is terrible for your investment returns. Every time you trade, you pay transaction costs. Every time you sell, you may owe taxes on any gains. And research consistently shows that frequent traders dramatically underperform buy and hold investors. For retirees, the best approach to technology investing is set it and forget it. Buy the fortress technology companies I have described. Reinvest the dividends. Check your portfolio once a quarter, maybe once a month at most, and otherwise ignore it. Do not watch the daily price movements. Do not react to news headlines. Do not listen to talking heads who are paid to be dramatic and alarming. Over any 10-year period in stock market history, patient investors who bought quality companies and held them through volatility have made money every single time. There has never been a 10-year period where the broad stock market lost money for buy and hold investors. Individual companies can fail, which is why diversification matters. But the overall market and the best companies within it have always rewarded patience. I want to tell you another story that illustrates this point. In 2008, during the financial crisis, Apple stock dropped over 50% from its peak. The headlines were terrifying. Banks were failing. The economy was collapsing. Experts were predicting a second Great Depression. Many investors panicked and sold their Apple stock. They could not handle watching their investment lose half its value. But think about what happened next. Apple did not go bankrupt. They kept selling phones. They kept generating cash. The iPhone was just getting started. Over the next 15 years, Apple stock increased by more than 2,000%. Investors who sold during the panic missed one of the greatest wealth-building opportunities in stock market history. Investors who held through the volatility and kept reinvesting their dividends created fortunes. That is the lesson. The fortress technology companies I have described will be volatile. Their stock prices will drop, sometimes dramatically, during market corrections. This is inevitable. But if you own the right companies with impregnable competitive positions and fortress balance sheets, those drops are temporary. The businesses keep operating, the cash keeps flowing, and eventually the stock prices recover and reach new highs. Let me also address the artificial intelligence revolution and what it means for retirees investing in technology. You have probably heard a lot about artificial intelligence over the past few years. ChatGPT, generative AI, machine learning, all of these technologies that are supposedly going to transform everything. And there is truth to this. Artificial intelligence is a genuine technological transformation. It will change how businesses operate, how work gets done, how we interact with technology. But here is what I want you to understand. The fortress technology companies I have described are the biggest beneficiaries of artificial intelligence. They are not threatened by AI. They are the ones profiting from it. Microsoft has a massive partnership with OpenAI, the company that created ChatGPT. They have integrated artificial intelligence into every one of their products. Their Azure cloud platform is where many AI applications run. When companies want to use artificial intelligence, they pay Microsoft. The AI revolution is not something that threatens Microsoft. It is something that is making Microsoft more valuable and more essential. Apple is integrating artificial intelligence into the iPhone and all of their products. This makes their devices more valuable and more useful to customers. It strengthens their ecosystem advantage. It gives people more reasons to stay in the Apple world. Apple's approach to AI emphasizes privacy and on-device processing, which aligns with customer preferences and differentiates them from competitors. Visa processes the payments for AI companies and for the increasing economic activity that AI generates. As AI makes the economy more productive, more transactions happen, and Visa collects fees on all of them. Artificial intelligence is creating new businesses, new services, new ways of spending money, and Visa benefits from all of it. The companies that might be harmed by artificial intelligence are smaller, weaker companies that cannot afford to invest in AI or that get disrupted by AI-powered competitors. The fortress technology companies are not in that category. They are the ones doing the disrupting. This is why I am not worried about AI threatening my technology investments. I am excited about AI accelerating the growth of the technology companies I already own. The same competitive advantages that make these companies safe, their scale, their resources, their existing customer relationships, are exactly what allows them to lead in artificial intelligence. Now, let me give you some practical advice about how to actually implement this technology strategy in your retirement portfolio. If you have an existing retirement portfolio with no technology exposure, do not rush in and buy everything at once. Instead, build your position gradually over 6 to 12 months. This is called dollar cost averaging. You invest a fixed amount each month, regardless of what the market is doing. When prices are high, your fixed amount buys fewer shares. When prices are low, your fixed amount buys more shares. Over time, this averages out your purchase price and reduces the risk of buying everything at a market peak. If you have an existing technology allocation that includes speculative companies, consider trimming those positions and reallocating to the fortress technology companies. You do not have to sell everything at once, but over time, you want to shift away from risky speculative bets and towards stable, profitable businesses. Make sure your overall asset allocation is appropriate for your age and situation. If you are over 60, you probably should not have more than 40 to 50% of your portfolio in stocks overall. The rest should be in bonds, cash, and other more stable investments. Your technology allocation should be sized relative to your stock allocation, not your total portfolio. Consider the tax implications of any changes you make. If you hold investments in taxable accounts, selling can trigger capital gains taxes. In some cases, it makes sense to hold on to an investment even if it is not ideal, simply to avoid a large tax bill. In tax-advantaged accounts like IRAs, you do not have to worry about this. Consult with a tax professional if you are unsure about the implications of any changes you are considering. Rebalance your portfolio periodically, maybe once or twice a year. If technology stocks have a great year and grow to be a larger percentage of your portfolio than you intended, sell some and reinvest in other areas. If technology stocks have a bad year and become a smaller percentage, buy more to get back to your target allocation. Rebalancing forces you to sell high and buy low, which is exactly the opposite of what most investors do emotionally. Let me close with some thoughts about what the future holds for technology investing. Because understanding the long-term trends is important for having conviction in your investments. Technology is not going away. It is becoming more important every year. More of the economy runs on technology. More jobs depend on technology. More daily activities involve technology. This is not a fad that will reverse. It is a permanent shift in how human civilization operates. The COVID pandemic accelerated digital transformation by years. Companies that were slow to adopt technology had to catch up quickly. Consumers who had never shopped online started ordering everything from the internet. Workers who had never used video conferencing became experts at virtual meetings. These changes are not going away. They are permanent shifts in behavior. The fortress technology companies I have described are positioned to benefit from this shift for decades to come. They are not dependent on any single product or trend. They have diversified businesses that will adapt and evolve as technology changes. They have the financial resources to invest in whatever comes next, and they have competitive advantages that protect them from disruption. 20 years from now, I am confident that Apple will still be the dominant consumer technology company. Microsoft will still be essential to enterprise computing. Visa will still process a huge portion of global payments. The specific products and services might look different. The iPhone of 2040 might bear little resemblance to the iPhone of today, but the companies will still be dominant, still profitable, still returning cash to shareholders. That is the beauty of investing in fortress technology companies. You do not have to predict what specific technologies will win. You do not have to guess which products will succeed. You just have to recognize that these companies have the scale, the resources, and the competitive advantages to adapt and dominate whatever comes next. For retirees, this provides something invaluable: peace of mind. You can own these investments knowing that you do not have to watch them every day, do not have to worry about every news headline, do not have to stress about whether your companies will survive. You can focus on enjoying your retirement while your investments quietly compound and grow. That is what successful retirement investing looks like. Not excitement, not drama, not constant trading and worry. Just owning excellent businesses, collecting your dividends, and letting time work in your favor. So remember what I have told you today. Technology investing is not inherently risky for retirees. Speculative technology investing is risky. Fortress technology investing is one of the safest and most rewarding strategies available. Apple, Microsoft, Visa, and a diversified technology ETF belong in every retirement portfolio. Speculative, unprofitable, highly leveraged technology companies do not. Build your technology allocation gradually, size it appropriately within your overall portfolio, hold through volatility without panicking, reinvest your dividends, and let the power of compound growth work for you over the years and decades ahead. If you do these things, you will participate in the greatest wealth creation engine of our generation while protecting the capital you have spent a lifetime building. And that combination of growth and safety is exactly what every retiree should be looking for. The technology revolution is not something to fear. It is something to embrace carefully and intelligently with the right companies in the right proportions. Do that, and technology will be one of the best things that ever happened to your retirement portfolio. Now let me share a few more critical insights that I think every retiree needs to understand before investing in technology. The first insight is about dividends and why they matter so much for retirees. When you are working and saving for retirement, capital appreciation is what matters most. You want your investments to grow in value so you have more money when you retire. But once you are retired, income becomes critical. You need cash coming in to pay for living expenses. You need money to cover healthcare costs, housing costs, food, travel, and everything else that makes retirement enjoyable. This is where the fortress technology companies excel. Apple has increased its dividend every single year since they started paying one in 2012. Microsoft has increased its dividend every single year for over 2 decades. Visa has increased its dividend every single year since they went public. These are not just growing businesses, they are growing income streams for retirees. Think about what that means over a 20-year retirement. If you buy these stocks today and hold them, your dividend income will likely double or triple over the next 2 decades. The same shares that pay you a certain amount this year will pay you significantly more 10 years from now and even more 20 years from now. That growing income helps offset inflation and reduces the risk of running out of money during a long retirement. The second insight is about the importance of mental accounting when it comes to technology investments. Many retirees make the mistake of looking at their technology holdings separately from the rest of their portfolio. They see a 30% decline in Apple's stock and panic, forgetting that Apple represents only a portion of their total wealth. The right way to think about your technology investments is as one component of a diversified portfolio designed to meet all your retirement needs. You have bonds for stability and income. You have other stocks for diversification. You have cash for emergencies and near-term expenses. And you have technology for growth and inflation protection. When one part of your portfolio declines, other parts may be rising or holding steady. That is diversification at work. It smooths out returns and reduces stress. If you find yourself checking your technology stocks every day and worrying about every fluctuation, you probably have too much allocated to technology. Reduce your allocation until you can ignore the daily movements and focus on long-term results. The right allocation is the one that lets you sleep at night while still giving you meaningful exposure to growth. The third insight is about the role of dividends, reinvestment, and building wealth. If you do not need the dividend income from your technology stocks to cover living expenses, consider reinvesting those dividends automatically. Most brokerage accounts offer dividend reinvestment programs that use your dividend payments to buy additional shares. This takes advantage of compound growth in the most powerful way possible. Let me give you an example. If you invest $10,000 in Apple today, and the stock returns 8% per year with a 2% dividend yield, after 20 years, your investment would be worth about $46,000 if you just held the stock. But if you reinvested all the dividends to buy additional shares, your investment would be worth about $67,000. That is over $20,000 in extra wealth just from reinvesting dividends. And the longer your time horizon, the bigger the difference becomes. The fourth insight is about staying rational during market panics. I have lived through many market crashes. The crash of 1973 and 74, Black Monday in 1987, the dot-com bust in 2000, the financial crisis in 2008, the COVID crash in 2020. And I can tell you that every single one of them felt like the end of the world at the time. The headlines were terrifying. Experts predicted catastrophe. People were certain that this time was different, that the economy would never recover. And yet, here we are. The market recovered from every single one of those crashes. Patient investors who held quality companies through the panic were rewarded handsomely. The people who lost money were the ones who sold at the bottom, who let their emotions override their judgment, who forgot that great businesses can survive any crisis. When the next market crash comes, and it will come eventually, I want you to remember this. The fortress technology companies I have described are not going bankrupt. They have too much cash, too many customers, too many competitive advantages. Their stock prices will decline temporarily, but the businesses will keep operating. The dividends will keep flowing, and the stock prices will eventually recover. Your job as an investor is simply to do nothing during the panic. Do not sell. Do not watch the news obsessively. Do not listen to people predicting doom. Just wait. In a year or two, you will be glad you did. The fifth insight is about the long-term power of quality compounding. Einstein supposedly called compound interest the eighth wonder of the world. Whether or not he actually said that, the sentiment is absolutely true. The power of compounding over long periods is almost magical. Consider this. If you invest $100,000 in fortress technology companies that grow at 10% per year, after 10 years, you will have about $260,000. After 20 years, you will have about $670,000. After 30 years, you will have about $1.7 million. That is the power of compound growth over time. But here is the crucial point. You only get those returns if you stay invested. Every time you sell during a panic, every time you try to time the market, every time you switch to the hot new thing, you reset the clock on compounding. You lose the accumulated gains and have to start over. The investors who build serious wealth are the ones who buy quality and hold for decades. This is why I emphasize fortress technology companies so strongly for retirees. These are businesses you can buy and hold for the rest of your life. You do not have to worry about them going bankrupt. You do not have to worry about timing the market. You just buy, hold, and let compounding work its magic. One final thought before I conclude. Technology is not just about making money. It is about participating in one of the most exciting periods of human history. The innovations happening right now in artificial intelligence, in healthcare technology, in renewable energy, in space exploration, in computing power, these developments will change how humans live and work in profound ways. By owning fortress technology companies, you are not just building wealth for your retirement. You are participating in this transformation. You are a part owner of the companies that are shaping the future. There is something deeply satisfying about that, about knowing that your investments are connected to real progress and real innovation. So embrace technology investing, but do it wisely. Focus on the fortress companies with proven track records, strong competitive positions, and consistent cash flows. Avoid the speculative bets that can devastate a retirement portfolio. Size your allocation appropriately for your age and risk tolerance, and hold for the long term through whatever volatility the market throws at you. If you follow this approach, technology will serve you well throughout your retirement. It will provide growth when you need it, income when you need it, and inflation protection when you need it. And it will let you participate in the greatest wealth creation engine of our generation while protecting the nest egg you have worked a lifetime to build